If you Google, how should I invest my money in 2025, you get 58 million search results, each teaching you a different way to get rich. So, how can you cut through all the nonsense and find the right answer for you? Well, for the past 15 years, that's been my job. Help people set and achieve their financial goals so they can earn more and retire earlier. And I've invested millions of pounds in the process. So, in this video, I'm going to teach you the 10 most important lessons for investing in 2025 and the one big mistake that everyone struggles to avoid. So, without further ado and a bit of irony, let's become search result 58,000,001. Let me ask you a question. If you were going to build a house, would you A, sit down, make a plan, set a budget and a timeline, or B, just start haphazardly laying bricks? Now, I assume that most of you said A, at least I hope you did, or I'm never coming to your house. But when it comes to investing, a lot of people do the equivalent of option B. Rather than making a plan, they invest a load of money into something they don't really understand based on, I don't know, a friend's recommendation or something they've read online. But when you dig into their personal finances, you find a big mortgage, a student loan, 2 credit cards maxed out, an expensive car loan, no emergency fund. They're sitting on a pile of debt. So the first step is to get your house in order and make sure you're actually ready to invest, because you cannot build anything on weak foundations. So in this case, there are 2 things we would need to fix. Firstly, if you don't have an emergency fund, what happens if something goes wrong? You suddenly get fired or you need to pay for a huge repair on the house. You cannot make rational decisions if you are stressed and worried about how you're going to pay your rent or your mortgage. So even though a disaster might seem unlikely, I always advise my clients to have between 3 and 6 months of their living costs saved for a rainy day. Secondly, having some debt isn't always an issue, but there is a difference between good and bad debt. Let's say you make 8% a year from investing, so you think you're winning. But at the same time, you're paying 14% interest on credit card debt. In other words, it's a total waste of time and you're still going backwards. So my advice is to focus all of your efforts on using your spare income initially to pay down those expensive credit cards, car loans, everything except your mortgage if you have one. When you've done this, only then focus on building up 3 to 6 months rainy day money. Only when you've done this are you really ready to move on to lesson number 2, which more people get wrong than you might think. So, if you're watching this video, you know you should be investing, but how much money should you invest? Why do you want to invest? And how big do you need the pot to be? It's much harder to get started and even harder to stay on track when there is no track to follow. So, lesson number 2 is to set very clear goals, such as I want to retire at 55, I need to have 50 grand a year to live on in retirement, and I want to own our house outright when I get there. Because if you set clear goals, you can take clear actions and it will stop you dipping into savings to buy things that you don't need to impress people that you don't even like, and pulls you further away from your goals in the process. Number 3 is all about perception. Most people invest into an asset because they believe it will increase in value over time. But people's perception of good is completely warped. People imagine a good investment to look like this, a straight line that goes from good to better. But I'm going to show you a graph of the UK property market right now, which many people would say has been a fairly good investment over the past 20 years. And if we look at the graph, we can see that the price has gone up. However, if you zoom into a 12-month period, you will see that the line goes absolutely crazy. And if you zoom into a daily view, the results are even crazier. So let's imagine for a moment that you decided to buy a rental property back in 2004 because you believed in the market. Then it crashed in 2008. You panicked and you sold your house. Not only would you have lost a load of money, by panicking, you would have lost out on all the profit that comes further down the line. And this is the third lesson to investing. Nobody knows if the market is going to go up or down in the short term. And even good investments will have periods where they go down. So when you start, you need to think long term and be mentally prepared for when you see your investment value drop from the last time you checked, because I can promise you this will happen. However, if you're going to invest and start taking risks with your money, You need to actually understand what risk is because this is something people often get wrong. Let's look at these two assets, for example. On one hand, we have Bitcoin, and on the other hand, we have a blue chip stock like Apple. You can see that Bitcoin's price jumps around a lot more. It is constantly going up and down, whereas Apple's performance is much more steady in comparison. So, if we were purely measuring on volatility, it would be fair to say that Bitcoin is far riskier than investing in Apple stock. But in order to become a good investor, you need to reframe this whole idea of risk. Let's say you're so worried about the volatility of the stock market, you don't invest at all. Instead, leave your money as cash in the bank. What's the risk of that? What's the risk of taking no risk? Well, the risk is that inflation is going to eat away at your money. Your cash in the bank has not kept up with inflation, plain and simple. So you're going backwards, eroding your wealth every year by, in theory, playing it safe. So don't let volatility frighten you away from investing. Understand it and embrace it. Otherwise, you run the biggest risk of them all, not achieving your objectives, not retiring at 55, not paying off that house. Because in my view, the risks that come with not investing are much higher than the volatility that comes with investing in the right way. Just to be clear, I'm not suggesting you go out and invest in the most volatile and risky thing you can find in the hope that it goes to the moon. That is also unlikely to end well. Because, as we established earlier, nobody, not even the best investors in the world, know how specific assets will perform in the future. If you take all your cash and invest in a couple of stocks because of some basic research or even worse, a hunch, you are basically just gambling. I can tell you from experience that you are setting yourself up for a lot of sleepless nights. So, what can we do instead? Well, the way to de risk your investments and be less reliant on specific stocks is to diversify, which is a buzzword I'm sure you've heard before. So, let me explain exactly what I mean and the easiest way for you to diversify your investments. Let's pull up another example. If you invest in Apple, you are basically betting that one company is going to perform well. If you invest in Apple, McDonald's, and Nike, you are betting that three companies in three different industries are going to perform well. So it's a bit more diversified. But an easier and safer way of diversifying is to invest in something like the S&P 500. And for those of you who don't know, the S&P 500 is an index, a list essentially, which basically allows you to invest in 500 of the biggest US companies all at once, hence increasing your diversification even further. It's cheap, really easy to do, and much more diversified than being in a handful of stocks because you're betting on the well being of a huge chunk of the US economy instead of any one particular company on its own. Indexes and index funds aren't unique to the US either. We also have the equivalent here in the UK, the FTSE, in Germany, the DAX, Japan, the Nikkei, and loads of other countries around the world. You should be looking to create a portfolio of investments by investing in different index funds from around the world because rather than betting on one company performing well, you are spreading your bets across multiple companies in multiple countries. You should aim to be a global investor. By the way, if you want help actually working out your own portfolio, every month I'm going to be offering 5 free guidance calls to help my subscribers manage their finances better. So check out the link in the description to apply. For this next lesson, we're going to dig a bit deeper into the diversification mindset. I want you to think of your money like a football team. If you were going to pick 11 players to put out on the pitch, you would probably choose a mixture of attacking and defensive players. The attackers to score the goals and the defenders to make sure you don't concede any yourself. Because 11 defenders wouldn't get you anywhere, and 11 attackers would be complete mayhem, although might make for an interesting watch. Your investments should be similar. You might want to balance out your portfolio so that you have the right mix of riskier or more volatile assets like stocks and shares, alongside some more boring defensive assets like bonds, which, generally speaking, perform differently to stocks and won't be as volatile. So, what should you be picking? Well, let's say you have a long-term objective that is 20 or 30 years down the line. You can increase the allocation to stocks because short-term volatility is less of an issue. Whereas for objectives in the medium term, you might like to have a look at having a higher allocation to bonds to calm down the ride. Remember, the best investment is the one you can stay in your seat for. So build a portfolio which you are comfortable sticking it out with in the good times and the bad. So now you have your goal and you know roughly what you want to invest in. The question becomes, how do you actually go about investing in 2025? Where do you go? Well, back in the day, you'd look for a stockbroker with one of those 80s looking mobile phones and expect people to be waving around bits of paper and shouting at each other. But thankfully, it's a little different nowadays. With the internet at our fingertips, we now have millions of options available to us, which is great, but it can be a bit overwhelming. And it's important to invest in the right place because if you pick the wrong platform, you could end up paying way too much in fees. Choosing the wrong provider for the country you're in, giving yourself tax headaches, or even worse, getting scammed with some dodgy company. So, when you are choosing a provider, the main things you need to look out for are they must be FCA regulated, they must offer a good range of accounts or tax wrappers, as they're known, they should offer a pension and an ISA as a minimum, they should offer a good range of investment funds so you've got plenty of choice for your portfolio, and finally, they should be competitive on costs. So, to make this slightly faster for you, some of the main platforms for DIY investing that you might consider are Trading 212, Invest Engine, Interactive Investor, Hargreaves Lansdown, to name a few. There's loads, but for my DIY investing, the one I personally use is Trading 212 because I really like the app, it's really cost effective, and has loads of investment options. If you think it's right for you too, you can use my affiliate link in the description to get a free share on sign up. And if not, I'd recommend checking out the other platforms. A really good resource if you want to do more reading on the different platforms available and their pros and cons to help you find the right one is boringmoney.co.uk. And once you have chosen your platform, you have another important choice to make that will help you pay less tax. On investment platforms, you can invest your money in different accounts, such as ISAs and pensions. However, most people who get started on investment platforms don't understand the different accounts and how they really work. So they just pick one they've heard of. But this has a huge impact on the returns you will get because what most people don't realize is that the account you choose is called a tax wrapper. It sits around your investments that dictates what taxes you will or won't pay on any profit you make. For example, any investments inside an ISA wrapper are totally exempt from capital gains tax, income tax, tax on dividends, the lot. It's like a force field around your investments, which means you keep more of the returns. So lesson number 8 is to choose your wrappers wisely. This is a whole video topic in itself, so I won't get into all of the different options, but you need to understand what the wrappers are, how they work, and the allowances and rules around them so that you can use them to your advantage. So I will put a link in the description for you if you want to learn more. Now you're set up and ready to invest, lesson number 9 is going to ensure that you actually go ahead with your plan. Because you would be surprised how many people get distracted or spend ages procrastinating on YouTube or trying to find new ways to spend their money instead of actually sticking to their plan. So the best thing to do is take that option away from you and automate your investing. So how does this work? Once you've decided on a reasonable amount of money that you could invest every month, that is affordable for the long term and something that you can stick to, then set up a monthly instruction, a direct debit into the new account that you've opened with your new platform provider, so that the money goes straight from your bank into your investment without fail every single month. And it should happen the day after payday. That way, you never even see the money. You never get tempted to spend it, and it will be much easier for you to hit your investment goals. Simple. Which brings us to the final lesson. And it's by far the most important and exciting part about investing because it can literally help you 10x your money while you sleep. So imagine I gave you £100. If you spent that money right now, you could buy £100 worth of goods. But if you held on to that money and spent it in January 2026, you wouldn't be able to buy as much because inflation will have eaten away at the value of that money. So the same £100 will be worth maybe 3, 4, 5% less. In other words, it won't have the same purchasing power. But the exact opposite happens when you invest. By investing your money, you might make 3, 4, or 5% instead, hopefully more. And here is the interesting part. In year one, let's say you make an extra 5% on top of your £100. But in year two, that same 5% is now on top of your £105. That is the beauty of compounding interest. That said, when you're talking about £100 in 2 years' time, it doesn't sound that impressive. But what happens if you let £100,000 accumulate compound interest over the course of, say, 30 years? Well, if we assume a 5% return, you're looking at over £446,000. If it was a 10% return, you're looking at nearly 2 million quid. So the most important lesson to take away from this is summed up beautifully by Charlie Munger, one of the world's most famous investors. The big money is not in the buying or selling, but in the waiting. In other words, the longer you can let your investments compound without touching them, the more money you're going to make. And this ties in nicely with the big mistake I see investors making all the time, because in 2025, you're going to be bombarded with new investment opportunities, and inevitably there will be more stuff outside of our control that will happen to the economy, the housing market, stock market, etc. But the principles of building long-term wealth that we've gone through today are the same in 2025 as they were in 1975, and they'll be the same in 2085. And if you really want to start building wealth in 2025, the most important thing to do is avoid trends and fads. Just bet on the fact that the biggest and best businesses across the globe will always find a way to make profit, and then let time do its job. But as I mentioned earlier, one of the most important parts of investing is picking your ideal team and working out how attacking you should be. And the problem is, most people get drawn into the exciting world of stocks and shares because it sounds sexy. But could that approach be putting your money at unnecessary risk? Well, check out this video next to find out. That's lipstick on my head, by the way. Things I do for this channel.